All right. Good evening, everyone, and welcome to our SBR Grand Webinar Day 2. We have already covered a webinar Day 1 yesterday, and we had covered question number 1, which was Heliwell Company from our pre-March 2026 paper, Groups Pre-Populated, which is the most recent release by ACCA body. And today we're going to continue with the paper. We're going to crack question number 2, which is ethics question, which is Gillam Company, and another question which is Fuller, which is a question number, which is question called Fuller Company, which is investor focus question. Again, both the papers are from your pre-March 2026 attempt. Okay. So yeah, we will move ahead now. I hope you all have managed to open the pre-March 2026 paper today, because today it is working. This is a pre-March 2026 mock. And yes, today the portal is working, so we can actually go and see the actual question from the portal and crack it then and there itself. Second is, you all, I've already shared the PDFs with you all on the group, so you all can keep that also, and then you all can solve it on a Excel and a Word also. But of course, I've always told you all that at least 2 papers you should go and solve it on that look and feel of the real exam. Okay. Now, unfortunately, because of some technical issue, already the session has started late, so I'm not going to now take much time. I want to directly deep dive into the question. So at this point, guys, my screen should be visible, I should be audible, and I should be visible as well. Right now, everything is started. So I have a question from Hamad that should you all absorb or should you all make notes side by side? See, guys, it's really person to person. Some students are really fast with typing and they can absorb and type parallelly really fast. Okay, if that is the case, then of course do both. Do both. Don't waste your time. But of course, if you think that typing speed is slow and if you end up if you end up making your answers, drafting your answers right now, entire focus from the question explanation is lost, then don't do that. Then just sit and absorb. Okay. So it's case by case, guys. It's case by case. All right. So you will use the navigator and come to question number 2, everyone. Use the navigator, come to question number 2, as we're going to crack Gillam Company. I had shared the agenda in the group anyway because there was a lot of delay. So meanwhile, I had already shared the agenda in the group that we're doing Gillam and Fuller. So we will read the background, the requirement, and exhibits one by one. And one by one, when we read the exhibits, we will also start cracking them. Okay. So let's start. Okay. Gillam Company constructs commercial property, which it either sells or holds to lease out to tenants. So there are 2 things it does. It sells or holds to lease out to tenants. And what it does, constructs commercial property. Financial statements are prepared in accordance with IFRS accounting standards. It has a financial year end of 31st December 2027. So it's a calendar year end. Okay. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Sale and leaseback provides information about sale and leaseback arrangement entered into by Gillam. And there is an internal email which provides a copy of an email from Gillam's finance director to its finance manager. This information should be used to answer the question requirements within your chosen response options. Now we go to the 20 marker requirements. What are they broken into? All right. Now using exhibit 1, explain with supporting calculations. Explain, the question word is explain, and with supporting calculations. So you have to do calculations as well. How the sale and leaseback arrangement should be accounted for in Gillam's financial statements for the year ended 31st December 2027. For this particular date, they want how the accounting. They want the accounting for this particular date. They want the accounting, and accounting of what? The sale and leaseback arrangement. So the ask is very clear, very specific, and this is worth a 8 marks. So you will do the number crunching and you will do the explanation both, and this is worth 8 marks. So I don't see any challenge, because when you do a sale and leaseback, and if it is an actual sale, if it meets the IFRS 15 criteria, then you know that journal entry is very intense, right? You have like 5 line items in the journal entry. Then there is so much to do in the calculation. So I will already visualize that there is so much marks stored for me in the numerical, 5 marks easily stored in the numerical. So when I start explaining, if I have enough explanation to fetch 3 marks also, I'm good. Okay. So I will see, or I will break my requirements in this fashion. Now, what I will do is I will copy this requirement. I just don't like when it highlights unwanted things. Yeah. So I'll just copy this requirement and I'll take this on my word processor so that when I'm keying in my answer, I exactly know what the requirement is. Okay. And the ethical issues of scenario 1 and 2 also, if you want, we can take this as well. Okay, so we have copy pasted the questions on our word space that is given to us. You can do this literally on your exam day. Okay, this is possible because whatever you can do here is exactly what is possible also on your exam day. Now, remember, they wanted the accounting of sale and leaseback on 31st December 20x7. When you say sale and leaseback, which standard hits you? Which standard? Quickly. These are small, easy questions which I'm asking. Put it in the chat box, guys. IFRS 16 leases, of course, IFRS 16 leases has a subtopic dedicatedly called sale and leaseback. Now, even before I start reading the, scenario, I want you all to quickly recall and tell me, in sale and leaseback, first you have to identify whether it is scenario A or scenario B. What are the two scenarios? What is the possibility? What are the two scenarios? In the chat box, quickly. Yeah, Muhammad Hamad has written quite quick short words, whether it's a sale or not an actual sale. Perfect. This is what the two scenarios are. So you'll have to identify that mostly the scenario will be also around identifying. Mostly they must have not given that this is the scenario. You will also have to identify and then provide the correct accounting treatment for it. Anyway, let's read further. One of Gillam's investment properties is West Side. Okay, which it leases to tenants. Gillam built this property 2 years ago following the sustainable building guidelines recommended by the government. Subsequently, Gillam has not followed these guidelines in its new construction projects due to the cost of applying them. So earlier when it started, it did apply the guidelines given by government around sustainability. But after that, since recent times, it has stopped applying. Okay. Now, Gillam applies the okay. By the way, this information from my lease perspective, IFRS 16 is not relevant. But why did I stress? Because this is also an ethics question. It will become relevant there. It's an ethics question. It will become relevant there. Okay. It's on the ACCA, yes, practice platform, the where the past papers are there. This is a pre-March 2026 mock. You can see on the left-hand side the name. So you have to go to all the SBR papers, assign yourself this paper here, okay? Next, Gillam applies the fair value model to investment property. It uses fair value model. In its interim statement of financial position at 30th June 2007, the carrying amount of Westside Tower was equivalent to its fair value of 20 million. So they're preparing something called interim statement as well. Many organizations will prepare probably quarterly statements, half yearly statements. They do that. Okay. So it has prepared an interim statement at 30th June. And at 30th June, they're saying why am I not able to highlight this? Yeah. And at 30th June, they're saying that the property value is equal to the carrying amount of Westside Tower was equivalent to its fair value of 20 million. The fair value and carrying value, they both are same. The fair value was unchanged at 31st December 20x7. At 20x7, the fair value was unchanged. Okay, the fair value is still my 20 million only. Now, on 31st December 2007, Gillam entered into a sale and leaseback arrangement. Which date did it enter into a sale and leaseback arrangement? Since which date it started the sale and leaseback arrangement? From 31st December 2007, it started. And we also have a valuation of this property at that same date, the carrying value and fair value being the same. Gillam entered into this, okay, in a sale and leaseback in relation to Westside in order to realize cash to fund a new construction project. The transfer of Westside met the criteria in IFRS 15 revenue from contracts with customer. It met the criteria. This date, it met the criteria of IFRS 15 revenue from contracts with customer. At this point, I want you all to use IFRS 16, the sublease requirement, sale and sorry, not sublease, sale and leaseback requirement. Think and tell me, is this falling in the actual sale or not an actual sale scenario? Which is the scenario? Yes, this is an actual sale. Why? Because it has met the criteria of IFRS 15. So you have to be able to grab that quick, easy mark by saying that because it has met the IFRS 15 criteria, this is an actual sale. If it's an actual sale, then can you all tell me, quickly give me the journal entry? Anyone who has good typing speed and remembers the point. In the chat, the journal entry when it meets the actual criteria, when it meets the sale criteria. The journey, it's a mix, an amalgamation entry. It's an entry of sale and lease back. Anyone who has good typing speed can put in the chat box.
Up and down.
Yes, dear, please tell me, no problem.
Ngogara imocha more good, more paid, and it just eat.
Sorry? Are you trying to say you have some doubt, or I think your mic is by mistake unmute? If that's the case, let me mute it for you. Otherwise, you can type your question in the chat box. Okay, we've started to get the answers. So we have Mahira Kanda saying debit bank, debit ROU, credit asset, credit lease liability, credit gain on disposal. Yusuf is saying cash asset gain, ROU and lease liability. You gave me the 5 elements, but the debit credits are missing. Mohammed Hamad is saying debit bank, debit ROU, credit lease liability. Okay, perfect. Ram, same. Nicole, debit bank credit asset. Okay, but Nicole, you just gave me one part of the entry, the other is missing. Hamad is saying okay, yeah. Okay, fine. So most of y'all, majority of y'all have given me the correct journal entry. Okay, I'll break it for everyone. Debit bank. Why? Because money has coming in when you are selling the asset. Credit your asset is going out. Normally, when you do such a transaction, you're going to, of course, make a gain. So debit bank, credit asset, credit gain. Okay. Now what remains is the leaseback transaction. The sale transaction you already accounted for. In that same journal entry, you have to do your leaseback. You have to do your leaseback. Okay. So debit is your ROU because you have leased that asset back. So you have your ROU. And credit is what? You have to pay a liability against it. So that huge liability needs to show in your financial statements. So credit is your lease liability. Okay. Guys, you might think I've gone fast here, but the reason why I've gone fast here is this is something expected knowledge from you all. Okay, this journal entry you should know at this point. I'm not explaining this journal entry, I'm just quickly revising with you all. Okay, that's it. I'm just quickly revising. Now, next, let's read further. Under the terms of the sale and leaseback arrangement, Westside was sold for 22 million. It was sold for 22 million. So I hope you'll remember. Okay, let me highlight this in another color. Yeah. I hope you'll remember we said debit bank, right? Debit bank. So whatever the proceeds we are collecting will come against debit bank. Next. And immediately lease back for a term of 10 years. Payments are made in advance and commenced on 31st December 20x7. So the day you entered into this leaseback arrangement was 31st December 20x7 and the payment terms are advance. Okay. Okay, I'll come to it further. Now, lease payments are 1.25 million per year if stated carbon emission targets are met in the previous 12-month period. Okay. Okay, we will break this again. Okay. Lease payments are 1.25 million per year. These are your annual payments. If you may know that we do annual payments, in this case, they said the annual payments are in advance. So these payments we're talking about are per year if the stated carbon emissions targets are met in the previous 12-month period, which means that as per the contract, the lease payments are supposed to be 1.25 if there is some condition, okay, that if the carbon emissions of the 12-month period is met. If the targets are not met, an additional 0.15 million must be paid each year, making the total annual lease payment to 1.4 million. These targets were not met in the year ended 31st December 20x7. The following information is relevant. Okay. Now, in this paragraph, I want your focus to be on the regular, as per contract, the regular fixed, irrespective of anything, irrespective of whether you're meeting the target or not meeting the target, your annual payments are 1.25 million only. Okay. But yes, there is a condition that if target is not met, then yes, add a 0.15 million in that particular year. Add an extra 0.15 million in that particular year. Now, what they said, The following information is relevant. They're saying if lease payments are 1.25 million per year, the implicit rate is 4%. The present value of the future lease payments will be 9.3. But if the lease payments are 1.4 million, that additional 0.15 included, then the implicit rate is 6.9. And the present value of the future lease payments is 9.15. Now, at this point, the question was, what was the question? How will you measure the lease on 31st December? If you may remember, the question was very clearly, how will you measure the lease on 31st December 20x7, which means you need to give a value for your debit ROU today. You need to give a value for your credit lease liability. Okay. And of course, there is this profit element. Okay. There is a bank element and all of that. But I'm not coming to all the other parts. Let's even just, if we think from a ROU and lease liability perspective, okay. I want your judgment here now. Think about it. Here your pure judgment comes. Think about it. That what would be the present value for lease liability that you would have picked? A 9.3 or a 9.15? No eeny, meeny, miny, mo. Okay, you're not doing that. You need to think. There has to be some logic. Okay, justify in your head. If you're saying 9.3, why you're saying 9.3? If you're saying 9.15, why you're saying 9.15? Justify in your head and give me the answer. Okay. I don't want you all to just copy someone else's answer without thinking, okay? I want you all to think of it in your head and then give me an input. So you all are telling that in case target not met, then 1.5. Okay. Okay, now let me add some more like hints or details to this scenario. Okay, let me just help you all with that. The clause that if the targets are not met, then additional 0.15 million is required. This is something that is going to be checked every year, by the way, guys. That every year end, 31st December 20x5, check the previous 1 year, what were the carbon emissions. So if the carbon emissions were not meeting the target, then yes, they will take in that year a 0.15 million extra. But let's say if they were met, then you're still sticking to the original payment of 1.25 million only. Okay, this is always the case that 1.25 you're always shelling out, but that 0.15 additional is only case by case if that previous year emissions are not met. If only previous year emissions are not met. So this is a case by case scenario. Okay. So I think only one of the students is correct. Okay, there are two students, I think, who have given the correct answer. Jani and Mahirakant. Yes, you both are correct. See, guys, 9.3 million is the correct answer. And majority of you all I know have written 9.15. I know majority of you all have written 9.15 because the examiner has tried to trick you all here by saying that the targets are not met in the previous 12 months. So you all thought at inception, on day one, you will calculate the lease present value basis the behavior of last 12 months. The last 12 months is target not met. So you all are saying that, okay, it should be, sorry. Wait. Yeah. Y'all are most of the students have given me an answer of 9.15 million, saying that as targets are not met, the lease payments are going to be 1.4 million, and this is my present value. But understand one thing, that this is only of 1 year. I don't know now. Next year, maybe I'm meeting the target. Third year, I'm meeting the target. What is my sure shot? What is my sure shot outflow, irrespective of target being met or not? What is my sure shot outflow, irrespective of the target being met or not? 1.25 million. This is sure. This is every day as per the every year as per the contract. So my present value calculation has to be basis this fixed payment, fixed installments. This 1.5 that they're adding in this case is variable. Is case by case. If in a particular year not met, only then. So my present value calculation is can't be basis some variable factor over here. can't be basis some variable factor over here. It has to be basis a fixed factor. Then you all will be like, okay, in the current year, that 1.5, that 0.15 extra that we are paying, then how do you account for it? Of course, I understand that 0.15 has to be paid extra in the current year, but that will not form part of my lease liability calculation because that's not fixed. That's variable, that's outside it, and you will consider it outside it as an expense element for that particular year. It's almost like a penalty for you. It's almost like a penalty for you that expense you're recording in that particular year outside this lease arrangement. I hope this is clear for everyone. That this 1.15 is not part of fixed, so I can't calculate my present value basis that 0.15. I'm going to calculate my present value basis my fixed payments. So present value is basis these factors, and that 0.15 will be recorded as an expense. Okay. So yeah, now without wasting much time, let's get into the accounting of it. We have already read the scenario. So what I like to do is, this is our normal approach. If it is a numerical plus explanation, I like to do the numerical first, and then I like to explain it. So we'll do that. Okay, Mahira Khan, normally if the payments are based on some index, in that case, yes, that present value will consider the index payments basis the index. But any variability that is coming because of any other factors, then you can't. Then you have to just take the fixed part out of it. You have to just take the fixed part out of it. But yeah, let's say when you tell me about inflation, you know how much is the inflation. Let's say it's standard 2% every year. Then you can account for that inflation because you know it and you can account for it. See, anything for you to be put as a number, it has to be measurable also, right? Now, if your inflation is very variable, it's going to keep changing a lot. Then how do you account for it? So if you know it's fixed 2% every year increase, then yes, maybe that could be incorporated into your calculation. Okay. So anyway, I'm going to start now. I just want the reference of my question. It is requirement A, and there's no bit 1, bit 2 within it. It's requirement A only, simple. So sale and leaseback at 31st December 20x7. So we just discussed the journal entry. So I want my journal entry to be the, guiding force for me. Debit bank, we know because we're going to sell an item. Credit that property. So that property is going to get out of my books. Credit gain on disposal because I might mostly sell it at a profit unless of course there is a different scenario, but this would normally be the case. Because I'm leasing back, so debit debit ROU, right of use of asset, and credit lease liability. So all of you all also gave me this journal entry only. So I'm sure that you all are all good with this piece. Wow, what did it do? I did a control X and a control V. I think it took away my gain line item. Okay. Now, what are the straightforward elements from here? I know that the proceeds were 22 million. Do that. What about the disposal of property? When I disposed of the property, what was the carrying value of the property at that particular date? Can you look at the scenario and quickly identify and tell me what was the carrying value of the property when I disposed it off? The fair value and the carrying value. Can you see the word carrying amount over here? The fair value and the carrying amount, they both were same at this point. They both were, let me put it in a different color. They both were a 20 million only. Okay, it was this figure. So I'm interested in this figure. So I'm going to put this figure. Property went out for 20 million. Okay. Now lease liability, I already told you all that the lease liability is which figure I'm going to take from you, assuming that the lease payments are 1.25 fixed, okay, using the fixed part. So it's going to be 9.3 million. So my lease liability is 9.3 million. Now, the remaining two elements, ROU and gain on disposal, they are not going to be straightforward usually from the question. If you all have watched the sale and leaseback questions that I've done in the past, you know that these two elements are not straightforward from the question. It's formula based and you have to find it using the formula. No, guys, did I say 9.15 or did I say 9.3? The deal is that your lease payment present value should be basis the fixed payment. So fixed payment is 1.25. If by mistake I have said it as 9.15, if it's wrong, I've been constantly trying to say that it's basis the fixed payment, and fixed payment present value is what? 9.3. I think I highlighted also, no, 9.3. No problem, dear. So I have another question. Carrying value and fair value same on 30th June, not on 31st December. Please confirm. Well, let us, if you want, we can recheck this. Gillam applies the fair value in its interim statement of financial position at 30th June 2027. The carrying amount of West Side was equivalent to its fair value of 20 million. The fair value was unchanged at 31st December. Okay. So you're saying maybe the carrying amount at 31st December 2027 could be different than a valid question. But understand one thing, that when you are going to follow IS 40 investment property, okay, what happens is if you're using fair value model, do you depreciate? Do you depreciate? Yes or no? Quick question. Do you depreciate? No. So will your carrying value then not be still the same in this case? It will be the same, no? So your carrying value and fair value in this case is actually same. Okay. So yeah, I think we all are on the same page regarding at least this much information that I have captured. Okay. Now coming to my ROU and gain on disposal. Now understand one thing. Understand one thing. We have done a lecture when we were doing the leases topic. We had done one lecture. I don't remember if it was lecture number 2 or it was my lecture number 3. But I had done a sale and leaseback question in which I showed you all that if the selling price is more than fair value, then how will the sale and leaseback behave? Have I done this with you all? Yes or no? My regular students. My regular students of regular batch, in the lecture number 2 or lecture number 3, if the selling price is greater than fair value, then how will the sale and leaseback behave? Have I done the scenario with you all? I have done, yeah? Okay, great. So yes, this is precisely that scenario. Can you all see this? That the proceeds that has hit your bank is 22 and the property's fair value is 20 million. So it's 2 million extra. Can you recall? Can you recall what do you do when the proceeds that you're getting from the customer is extra compared to the fair value? Can you all tell me? Can you all tell me? Absolutely correct. Absolutely correct. You will make a split. The entire thing you can't record as a lease liability. You will make a split. So it will be split. 9.3 is not complete lease liability. From 9.3, you will have to remove the 2 million extra and record that as finance. I will repeat the logic. I know most of y'all will not remember. It was a very, see, so many things will all be very unique, right? Very small, little unique things. So I will repeat the logic. Don't worry. Wow. Why does it do this? I mean, am I supposed to do paste special? I'm just thinking. Anyway, I'll just help you all get what we have. So we're supposed to have over here my asset going out, my property going out, and credit is a gain element. And here I'm trying to break this lease liability with lease and finance liability. What does finance liability means? Like a loan element, like a loan element. Now the deal is, okay, understand this is very logical. That if something is worth 20 million in the market, the fair value, if it's something worth the 20 million, like people are ready to pay 20 million for this property. If you try to fetch it also, you'll get for this property for 20 million. But if someone has ended up paying you 22 million, then they have paid you 2 million extra. It means that 2 million extra that they're paying you is not actually as a part of lease back payments. It's not part of lease back payments. That 2 million is actually like a loan that he has given you, is actually like a loan that he has given you. That's why I'm not going to record this entire 9.3 as a lease liability. From this, I'll remove 2 and record the remaining 2 as finance lease liability. So if you see, the sum of this will be 9.3. The sum of this should be 9.3, but lease liability and finance should get separated for that extra element. Is everyone clear, or anyone has a doubt? Is everyone clear, or anyone has a doubt? Not required, Hamad, really. Not required. No, it's okay. If you want to present it in that manner, then again, there'll be other elements that I'll have to tweak in the journal entry. But anyway, right now I'm choosing no need to add. It's okay. You're just showing the lease payments for the future payments. Yes, it is very clearly mentioned. If you go back to the scenario and see, it's clearly mentioned these present value future lease payments are after the first payment. So 9.3 is after the first payment. If I want literally before the first payment, then yes, I will have to do 9.3 plus 1.25. Okay, 9.3 plus 1.25. Okay, I will repeat for more clarification. I'll repeat for more clarification. Just 1 second. Yeah. Guys, I have a lease liability at inception recorded as 9.3. If you all saw in the chart also, it was 9.3 given to me, right? And why it's 9.3? Because we decided that it's fixed payment. That's the most logical thing to do. So we have done, and even as per the standard, of course, you have to consider fixed payments and not variable. Variability should be considered in this fashion that, okay, depending upon some contingent criteria, 0.15 could be there, could not be there. You're not going to consider as per the standard also this variable element. So I have chosen the present value 9.3. This is fixed, okay? Now, this 9.3, when I recorded this as a lease liability, I had an issue. Why I had an issue? When the fair value, what people are ready to pay for this property in the market is 20 million, but someone has paid you 22, they have paid you extra 2 million here. They have paid you extra 2 million here. It's assumed, not it's assumed, rather from an accounting perspective, you have to record everything basis what the economic reality is, not what it is on paper. You don't check legal reality, you check economic reality in accounting. So economic reality in accounting is that 2 million nobody will give you for free. It's like a loan. It's like a loan someone has given to you. That's why it's not a lease liability that you will record in 9.3, that those payments, when you're getting those installments, that 2 million will not be a lease payment. The 2 million will be a loan payment, repayment that you will do. Sorry. When you're going to make the payment, that 2 million will be like a loan payment that you're doing. Yes, it's more than fair value, not carrying value. Yes, absolutely correct. Okay. So this is one piece. This is one piece. So here everyone is clear the split. And just one request I will do to you all. For this, I am not convinced with the solution that they have given to us over here on the website. Okay, I'm not convinced. There is an error as per me that they have done. They have taken lease liability full 9.3, and then they have taken additional finance liability of 2. Numerically that wouldn't sit right. Okay, numerically that wouldn't sit right also, and conceptually also it wouldn't sit right. That's not also what is there as per study hub notes as well. It's not also aligned with what is in study hub. So for this particular piece, I would highly recommend, do not follow the printed answer. Do not follow. I feel like they have done error over there. It's okay, there are errors sometimes. This is one of the error I feel like they have done. I'm not convinced with what they have done. It's not in line with the study hub. Okay. See, Jani, we will not increase the lease liability, because whatever is the lease liability that we are calculating, whatever the lease liability we are calculating and the payments we're going to do, we're going to assume that this entire lease liability payment that has been said between us and the party to whom we are selling of the asset, he's going to take that. He's going to take that in what form? He's going to take that eventually in the form of lease liability only from me. In those installments, he has embedded it. in the installments, he has embedded the payment. He's not going to take separately that 2 million. Otherwise, it would have been part of the contract that 2 million he'll take separately from me, right? That additional. But that's not the case. What is the legal term that has been set? That there is a sale that you have made for 22 million, and then when you're leasing it back, there are lease installments to be paid, which is of 1.25. So in that 1.25 only, he's going to manage to recover his 2 million. So that's why you're showing the segregation. Okay, so now let me proceed, guys. You all are asking me questions for what we are going to do now, right? So let me proceed, okay? So for the split part, I think everyone is clear. For the split part, everyone is clear. Now let's move ahead. The property also, we had said that we are very clear the carrying value that has to go out. The carrying value and fair value are same, but here you will put the carrying value, which also happens to be 20 million only. So it is going out of a books on the credit side, okay? Now, for my ROU, for my right of use of asset, okay, what are we going to do for my right of use of asset? So I'll just put this over here, like this is a scenario. Just SP is greater than fair value. This is my scenario, okay? Now, for my ROU calculation, do you all remember the formula for ROU calculation? And tell me the formula basis when the situation is SP is greater than fair value. So, what your formula becomes? Absolutely correct. Right? It is present value of lease liability divided by the fair value, into the carrying value. This is your formula. Absolutely correct. So, my ROU is going to be the present value of lease liability divided by the fair value multiplied by the carrying value. So in this case, my present value came to 7.3 divided by the fair value. How much was my fair value, guys? When I was selling it, 20. And how much is my carrying value? 20. So what is my ROU going to be like? My ROU is also going to be 7.3 only. If you apply this formula here, my ROU is also going to be the same. Okay. Just 1 second. Okay. Because this is not acting like a real Excel, right? So I have to do the sums at a physical paper probably. So anyway, at this point, if you may see my debit side, I'm getting 29.3. And if you see my credit side, again, I'm getting 29.3. So it's tallying already. But you will be like, we have not accounted for the gain yet. No, guys, please memorize. Hamad, don't do this. Don't do this. Memorize the formula. Don't do the balancing figure approach. Okay. Yeah. Now for the gain on disposal part, if you do the balancing figure approach right now, as per balancing figure approach, this is 0, right? So anyway, it will still be correct only, but I'm not a fan of balancing figure approach. You need to know the formula. Now for the gain on disposal, what do you do? Do you all recall the formula when the SP is greater than fair value? What do you do? When SP is greater than fair value, what do you do? Fair value minus the present value of lease upon fair value into the actual profit or total profit. Correct. This is what you would say, right? Fair value. Just 1 second. Yeah. Okay. Absolutely correct. This is what you will say. Okay. But in this case, in this instance, when the fair value, this is a very unique question, by the way. In this instance, when the fair value became equal to the carrying value, meaning when you sold the asset, your carrying value was 20 million. Okay. And the fair value as per the market was also 20 million. So you actually assume this is a no gain, no loss situation. This is a unique thing that you will have to absorb, okay? That this will be assumed as a no gain, no loss situation. You might be like, okay, but the selling price is actually 20 million, no? The selling price is actually 20 million, no? You will be like, sorry, 22 million, right? This is what you will tell me, no? That this is 22 and the carrying value is 20, right? But you know that in this scenario, wherever the selling price has been greater than fair value for comparison purpose, fair value has taken precedence. Fair value has taken precedence. So instead of, if I could strike this off over here, I don't know in this, I can strike this off or not. I can't strike this off. So instead of taking selling price for comparison, we will take fair value for comparison. And when you compare the fair value and carrying value, your gain or loss is zero. Gain or loss is zero. Gain is zero. So even if you apply this and multiply for the ROU formula, you will end up getting zero only. Yeah. Excess is loan. That's why in that selling price, that 22 million we can't consider because 2 million we're considering like loan only, no? So in that SP, we can't consider full 22. We can't consider full 22. You want you consider SP as 20, then it's fine. You want you consider SP as 20, then it's fine. So even if I do my gain on disposal formula that you all have told me right now, because my gain element itself is zero, see this formula that you all are telling me, right? Fair value minus the present value. This is the first thing. This proportion is, by the way, for the rights transferred. For the rights transferred upon fair value into actual profit. When I do this into actual profit, no, this actual profit, I'm trying to show over here, the actual profit is zero. Okay. Actual profit, selling price, I'll have to consider 20 only. I'll write a note. We're not considering 22 because 2 is like loan. Okay. If you want, I'll give a disclaimer here so that you all will always remember why I'm not considering the 2. And the carrying value is also 20. So the actual profit is 0. So whatever I do, if my actual profit is 0, whatever ratio comes, that ratio multiplied by actual profit, my gain on disposal is going to be 0 only. So this is why it's 0. So I've invested a lot of time. I've gone really slow in this journal entry. Okay. Because I want this to be really clear with you all. Yes, Aks, you're right. Absolutely correct. No, in the what they have done is they have taken the 2 as finance lease and they have adjusted that 2 also in ROU. That's what they have done. So that's where they have not gone correct. They have also not taken any gain, by the way. They have not taken any gain. Okay. Now the other thing, there is one more piece. This is one entry, okay? This is one entry. And they asked us to account for everything on 31st December pertaining to this lease. So what more is there pertaining to this lease? This is one journal entry. This is one journal entry. So first journal entry. But do you all remember that your ROU is also your lease liability? Yes, it's your lease liability, but ROU will also include any payments made on the same day or advance. Do you all recall this point? What is ROU as a measurement? Yes. So I need to account for that also. So my second journal entry on the same day, second journal entry of the same day I want to account for is two things I want to account. One is the extra penalty that they are paying, 0.15 million. So debit expense in PL, 0.15. Yeah, I think when we have to do it, you have to do that pay special thing and value. Only then it is going. Otherwise, it's not going. So anyway, the debit expense in PNL is 1.5. You want, you can write it like debit expense in PNL, or you can write penalty kind of thing. Okay, the way you would want to express it. This is one. So because of this, my bank will go down by 0.15 because of this payment. But the other payment that you're taking care of is also the advance payment. So that advance payment will lead to an increase in your ROU. And how much is that advance payment? By one installment, 1.25. So because of this, your bank will also go out by 1.25. So this is the other journal entry that you need to take care on the same day. So they have also done this thing, that they have combined this journal entry, this particular second journal entry with this particular journal entry. It becomes really a lot for you all. I want to keep my first journal entry very neat and clean, which is very clearly just the derecognition of my asset, okay, because you're selling the asset. So debit bank, credit asset, credit gain entry, and the debit ROU and the lease liability entry. I want to keep my first entry same to what you all have learned before. Okay, if I change this over here, then you all will get confused. So this is one entry. The second entry is about penalty and about the advance payment. So this, when they merge it, again more confusing, right? So if merging conceptually is fine, is correct. Numerically, conceptually, both it's correct, but it just becomes confusing. Is why I've kept it separate for you all. Second thing, what they have done is they have kept this lease liability as 9.3, and then they have taken a further finance liability of 2. That part is incorrect. Okay, that part I don't want you all to follow strictly. Huh? That part is incorrect. So Muhammad Hamad is asking, why are we taking 0.15? Where is it met that we did not meet? Dear Yannick, this is a question number 2. This is Gillam question number 2. Go to question number 2. Fuller would be question number 4. This is question number 2. Okay. So yeah, who was asking me that why are we doing this? Yeah, Hamad, I think you have asked, right? Yeah, it's very clearly mentioned in the question, Hamad, that we did not meet these targets were not met, no? It's very clearly mentioned. That's why this particular sentence acts really confusing, because the moment you see that the targets are not met, you will be like, oh, you know what? Let's take the 1.4 million per year payments, and this is our present value. Okay. So I think it's very clear. Now, any other doubts? So we never add or subtract from the lease liability ever. See, really depends there. Okay. Now, if your present value of lease liability included the 1.25, then on the day one, you would also show a journal entry to reduce the lease liability. Okay. You would also show this journal entry. But because the lease liability already does not include it, I'm not showing it. Simple as that. I'm not showing it. So understand one thing, guys. The impact on my ROU, if you may see, is debit 1.25, and from this entry, I can see a debit ROU of a 7.3. So if when I'm going to type a key in my answer, I will give a total ROU figure, okay? A ROU figure. So if you want to see in your financials, what will be your lease liability, what will be a ROU, these important figures, my ROU is going to be at 7.3 plus 1.5. Okay. My lease liability is going to be at because it's already excluding the first installment, so it's going to be 7.3 only. Okay. Any other important figure you would be showcasing at the financials? Yes, maybe the finance liability. So finance liability is going to be 2. But other things are credit, no, we're removing it. So you won't see them on financials. So if you want, for when you key in your answer, these are the important figures that you will end up reporting. See, Mahira can't, you can add that payment amount to the lease liability, but then all the accounting will also be according in that fashion. If you add it to the lease liability and show, then on that day, remove it and also unshow. Because 31st December, what you're going to do, you're going to make a payment. So lease liability also has to drop. So then do that journal entry, the dropping effect. For me, what is the point? If that step is already done, if they've removed it, then why do I add and remove again and show everything? It's not making sense, no? Is why I don't do it. Okay, so Ramchandra is saying that he's not clear with this journal entry, was clear with the old one. Who all have confusion in the second journal entry? Who all did not understand the second journal entry? Quickly raise hands. All the participants who did not understand, raise hands or put in the chat box. Okay, so if there's Talha, there's Subhasri, There's Ram, there is Kushal. Okay, there are like about good 4-5 people already, and then I'm sure there are more people who are shy who are not saying, right? So yes, I will repeat, okay? See, on because they asked me everything pertaining to this lease on 31st December. So just the sale and leaseback entry is this. I can't just stop here because there are more elements on 31st December that I have to take care because of the unique nature of this painted scenario, right? Unique nature. What is the unique nature? One is the penalty impact. They said that we did not meet the conditions. We did not meet the emission conditions. So, of course, the penalty will incur on us. So, penalty of 0.5, I have to record debit. Okay. How do we record expenses? Debit, no. You write expense in P&L, you write penalty, whatever. It's a debit item, it's an expense for me. This is what the examiner should understand. Okay. Nomenclature is anything that the management would want to put, right? Any which ways. So that's debit penalty 0.15. I have said that. Of course, if there is a penalty, it's either a payable or you have made a payment for it. So what first thing you would have done is a debit penalty of 0.15, and you must have done a credit bank. If you have settled it, assuming you have settled it, you must have done a credit bank of 0.15. Okay, this is one thing. The other thing that had happened on that day was an advance payment. Okay, that advance payment got taken care in the lease liability. Your lease liability is down already because of that, because your lease liability, they said, is clearly the present value of the payments excluding that first payment. So lease liability part is solved. But do you all recall that in your ROU is also the present value of the payments, but it also has to have that payments made on same day and in advance. So I have to record this in my ROU. So in my ROU, if I have to record, so debit my ROU. Okay. 0.125, and this must have reduced the bank. So it must have reduced the bank also by 0.125. So this is the entry that we're talking about. Yes, it's installment. The first entry I've taken care of already. Mohammed Hamad, the first entry have I not taken care already? Debit bank, credit lease liability, credit finance liability. I already took care of it. I did take care, no? Debit bank, credit lease liability done, no? The installment entry I'm not showing because they have already taken care of it, no? That's why I'm not showing. Okay. So guys, I'll move from here. I don't want to put more time here now. I think it's clear. I wouldn't put more time here. It's clear. So we will move ahead from here and we will start drafting the written part for it. We'll start drafting the written part for it. Okay. So because I have this right in front of me, drafting the written part becomes easier. Someone could have the approach of going and doing the written part first and then the spreadsheet. Up to you, but I'm not a fan because when you have the numbers right in front of you, writing becomes just mirroring it, right? Just copying it. How should I see? It was worth 8 marks. I already told you this is complex number crunching, so easy 4 to 5 marks must be here. So write enough so that you get a 3 to 4 mark in the written part. Okay. Now, as per IFRS 16 leases, by the way, if you don't quote it, but if you write this is as per the standard, it's enough. Okay. As per IFRS 16 leases, sale and lease back. In case of sale and lease back, it should be first identified whether the criteria of actual sale was met or not. If met, okay, as the criteria of IFRS 15 was met, therefore, this was an actual sale. So, state I have done, application I'm doing. because I know it's worth just 4 marks, I'll move quickly to application, because if I just do state, it doesn't make that much sense when I have just 3 to 4 marks, right? I need to do more application here. State, I can imagine 1 mark here, but not a lot, right? So I'm quickly moving to application. Okay. So when the transfer is an actual sale, we will record lease liability. Sorry, we will de-recognize the property at carrying value of 20 million. Record the proceeds against it of 22 million. The day one lease liability will be measured using the present value of future lease payments. We will only use the fixed annual lease payments of 1.15 million every year and not 1.4 million. This is because, sorry, 1.25 million, no? The annual payments are 1.25 million. This is because the annual payments, this is because the 0.15 million is a variable payment depending yearly upon target being met or not. Therefore, in the present value calculation, we will only consider the fixed installments, giving a present value of 9.3 million. Okay. As the proceeds were, because I'm going step by step. I said, okay, the lease liability is this much, but now I need to talk about 9.3 breakup also. As the proceeds were 2 million higher than fair value, the entire 9.3 million cannot be recorded as lease liability. $2 million from it should be recognized as a financing arrangement. Okay. So I'm talking about the lease. I've spoken about the lease liability. Now I need to talk about the ROU part. Okay. ROU is calculated as a proportion of rights retained applied to the carrying value, which is 7.3 million as per the scenario. Gain on disposal will be nil, as the actual gain on sale will be 0. This is because the fair value and carrying value were same 20 million. I just said I have to write enough so that I can get a 4 mark, right? So yes, this is enough to get the 4 mark. If you feel like you all want to write anything extra, you can write to be on the safe side. But for me, I feel like this is enough. I have already explained everything. Like I've explained, first I've justified that, okay, first I've given using state, I have justified that this is a actual sale. Then I've explained every element when it's an actual sale, that you do a debit bank, credit, asset. Okay, then gain is coming, but I'm talking about it later. Then I'm talking about the lease liability. So lease liability, I'm talking about the concept. Then I'm talking about the breakup, why the breakup is needed. Then I'm talking about the ROU. How do you measure it? and then I am talking about why the gain is zero. So if you see, when I had the formula in front of me, translating it into descriptive was a piece of cake. Versus if I have to do the writing first, then I have to think a lot. So I'll highly recommend this approach. Okay. Yeah, I think Muhammad Hamad, you said debit bank and credit lease liability. I think Ram has answered for you, right, dear? That if you're saying debit bank, then yes, you're paying, you're not receiving, right? So I think it's clear for you, or you still have some doubt. Okay, anyway, guys, let's move ahead now. We've invested, I think, good time, literally good time on this piece, but I really wanted you all to be clear, okay? So let's go to the next requirement. Using Exhibit 1 and 2, discuss ethical issues. No, it's okay, Mohammed Aman. We've already taken care of everything. Now, using Exhibits 1 and 2, discuss ethical issues arising from Bimal's instructions to Shammi and explain how Shammi should proceed. Okay. Just 1 second here. Okay. Yeah, we're sorted. Yeah, so we are talking about second one. Using Exhibit 1 and 2, discuss ethical issues arising from Bimal's instructions to Shammi and explain how Shammi should proceed. And this is worth a 10 mark. So let's see what the ethical issue is here. But they said using Exhibit 1 and 2, both. Okay, using Exhibit 1 and 2, both. Now, in Exhibit 1 itself, what ethical issue have we identified? One ethical issue that we have clearly identified, I would like to, you know what, change the color of the highlight because I'll remove the highlights now because I want to now highlight only ethical points. Let's quickly browse through this. Now my eye is just on ethical issues. One of the Gillam's investment properties is Westside, which it leads to tenants. Gillam built this property 2 years ago, you following the sustainable building guidelines recommended by the government. Subsequently, Gillam has not followed these guidelines in its new construction projects due to the cost of applying them. So this is one ethical issue that Gillam as an entity is not doing, not applying the rules or guidelines. Gillam applies the fair value, blah, blah, blah. The fair value remain unchanged till here. They're just talking about the numbers, nothing as an ethical issue. Gillam entered into the sale and lease back. Again, nothing as an ethical issue here. Under the terms, Westside was sold, blah, blah, blah. Lease payments said, okay. These targets were not met. Okay. Nothing as an ethical issue, really. I can identify in Exhibit 1, except that the Gillam has not followed. And let's see what impact it can have. Now, let's read the internal email. Okay, let's read the internal email. Okay, Gillam has commercial real estate IS2 inventory. Why is it using investment property? This is Hamad's question. Okay, so before I move to ethics, I'll just quickly clear this. See, Muhammad Hamad, Gillam is also probably selling, buying and selling, and it's also leasing out, right? So for the properties where it is going to, have the lease out model, where it is not going to, do a sale of an inventory kind of thing, because sale of inventory is sale of inventory. There it is lying in your stock, like that particular properties which you buy and sell is lying as an inventory item as per IS2. So not every investment property, not every building, not every flat need to be recorded as an IS2, only those on which you're trading. But on those which your income, your model is going to be, let's say, something else, which is a lease model, let's say, then yeah, investment property can be applied, no? Then on that, why IS2? Then on that investment property. You're not buying and selling that particular property, no? Okay. Bimal, the finance director of Gillam, is ACC qualified. He has just returned to work after an extended period of leave. He has sent the following email to Shammi, the finance manager. See, this might not be directly an ethical issue, but this could become a potential issue. So I'll highlight this as a potential issue, meaning if he's gone on an extended leave period, maybe he's out of touch of the accounting treatments and everything. So it could indicate or lead to a potential problem. Indirectly, maybe it's not an ethical issue. Okay. Now, next, Shami. In respect of the sale and leaseback arrangement, I think we should assume that missing the emission targets in 20x7 was unusual. And since West Side was constructed in accordance with sustainable building guidelines, the target is highly likely to be met in all the other years. I believe that meeting this highly likely threshold means that you should recognize the lease liability based on future lease payments of 1.25 million per year rather than 1.4. This will keep Gillam's finance cost to minimum possible and help ensure that the debt services covenants put in place by the banker met. First, he's saying that the 20x7 not meeting target is unusual. And because the construction at start was using sustainable building guidelines, the target is highly likely met in all the years. Can we go on an assumption basis? Because at the start, it was made using sustainable building guidelines. Can the director make an assumption then in the coming years also it will be the case that it will always meet? Is this a just going on some assumptions and doing accounting treatments based on such assumption, would it be right? Yes or no? Would it be right? Yes or no? I'll repeat. Yeah, of course not, right? Of course not. It's not correct. It's not the right accounting. It's not a right approach for your setting up your accounting treatment or your disclosures or anything for that matter, right? Also, if you may remember that only at the start sustainable building guidelines were followed, and then after that they even said that they could not follow it. They even said that they could not follow it. So this directors, you know, taking this fact as a base that okay, because they started it with conforming to the building guidelines, is also not the best thing to do because later they had stopped conforming. So this is also one issue. So this is a clear breach of ethical issue. But can you all tell me which ethical issue when he's just going to go on assumptions and also going to defy the facts? Like they did not follow the building guidelines later. So he's also defying these facts. He's also not, ready to accept these facts. And basis that he wants to do some disclosures or some accounting treatment. What ethical issue? It's a professional behavior problem. Also, very clearly another ethical issue breached. Integrity, right? He's not truthful. He's not honest. Okay, so yes, two problems. Then he's saying that I believe that meeting this highly likely threshold means that you should recognize the lease back liability based on future lease payments of 1.25 million per year rather than 1.4 million. See, his accounting measurement of 1.25 million per year will be correct because even we have taken that only. But is his basis for taking 1.25 million correct? Why are we taking 1.25 million? Because we are saying 1.25 million is the fixed portion. And we're not going to take the variable payment into consideration. We are just taking the fixed payment into consideration. This is our logic backed up by sound accounting knowledge. Why the finance director is taking? Because he's saying that he's meeting the highly likely threshold. His assumption is he's going to highly meet the threshold criterias. Is why he's saying that he wants to do 1 point. Is his basis for this accounting treatment correct? His accounting measurement is correct, agreed, but is his basis correct? No, it's not correct, right? So for me, I have to very clearly call out that even though his measurement is correct, but because his knowledge for the measurement is incorrect, he doesn't know the standard IFRS 16 leases that it has to take fixed payments into consideration. There's a knowledge gap. If there is a knowledge gap, then which ethical issue is breached, guys? Which ethical issue is breached if there is a knowledge gap? Professional competence. Yes, professional competence is breached because of the knowledge gap. Okay. Now, this will keep GLAM's finance cost to the minimum possible and help to ensure that the debt service covenants put in place by the bank are met. Now, what is his logic again for all this? Why is he motivated to report it as 1.25 per year rather than 1.4? Even though 1.25 is correct. What is his drivers? What is his motivation? That he wants to keep the debt covenants low with the bank, right? He wants to keep his finance cost low with the bank because if he will start showing higher liabilities, finance cost will also increase with the banks. Is this correct? Is this correct? Self-interest, threat to objectivity. Yes, absolutely correct. Objectivity is getting affected because he wants to manipulate the financials. He wants to show better finance cost. Objectivity is getting hampered. This is a problem. This is a problem. Okay, so objectivity is getting hampered here. Then. I'm going to keep this red only. All these issues that I'm highlighting. Okay, red. Next. Also, when you draft GLAM sustainability disclosures, there won't be much to write about at all. I think the most of the content should focus on the fact that GLAM applies sustainable building practices and as a result can access cheaper finance. He's saying that you do not write a lot of stuff. Do not write. Is this correct that he will not make enough disclosures which are required by the sustainability standards and the IFRS S1 standard as well, which is on disclosures? Do you think it is right that he's saying do not write much? Yeah, again, it's a problem. He's not going to be truthful. Integrity is an issue because the report that he will form for IFRS S1, which is on sustainability disclosures, will not be correct. Sustainability S1 disclosures will require correct disclosure, balanced disclosure, neutral, free from any biasness. It will require that. And here, of course, the director is highly biased, highly motivated to do things the way he wants to show better finance cost as a picture, right? So clearly, again, a breach. Because they have not been able to meet the threshold for the past 12 months, that should clearly be disclosed. The risk should also equally be disclosed. If they're doing the right things, disclose the right things that they're doing for the or the benefits that they're doing to the society. But if there are any risks that they're causing, so they could not meet the threshold, that's a risk, right? Carbon emissions probably were high. They need to disclose this. He can't hide it. By hiding it, he's of course concealing the facts, and integrity is a problem. Okay. Now, and he's saying that also not forget hiding also forget hiding. He's also saying that show that they're applying the sustainability building practices, but they were not, no, in between they were not. So again, not truthful also. All this for cheaper finance. So objectivity, integrity, everything is a problem still. Okay. Now, Shammi is also an ACC qualified accountant and keeps up to date with reporting regulations and requirements. The person who's being asked to do all this, however, is much updated with the reporting requirements. She's concerned about the instructions given by Bimal but is unsure what to do about it. Okay. So now what is the ask? Is the ask just ethical issues or is the ask even for actions? Let's read. Discuss ethical issues arising from Bimal's instructions to Shammi and explain how should Shammi proceed. So ethical issues, yes, you have to highlight using the PCOP, but you also have to say how Shammi should proceed, which means the actions by Shammi as well. This is what the 10 mark. So let's start. And this is the most scoring piece, guys. This is the most scoring piece in your paper. If that 10 mark is for ethics, you should get the full 10 mark. Okay. Shami's Shami's or I'll let me write FD. The finance director is asking Shammi to do accounting basis the assumption that they will most likely meet the criteria for low carbon emissions, and calculation should be basis that. This would be accounting basis certain assumptions, and this would be incorrect. Firstly, in the current year itself, there is evidence that thresholds were not being met compared to the FD's assumption. Okay, let me just go back to the email. Okay. Therefore, assuming that future years it will be met goes against the present evidence. This means FD is trying to portray a good picture based on false assumption. I'll call it false because he should also know it's false, right? I mean, clearly if FD knows false. Even though the accounting, the measurement suggested by the FD of 1.25 million as lease payments is correct, but the basis is incorrect. The 1.25 million is correct measurement as per IFRS 16, as it indicates the fixed lease payment. However, FD seems completely unaware of this principle and is trying to manipulate the books for certain advantages like better finance cost, from the banks. This is a gap in his knowledge. And a clear breach of professional competence. The first one, I did not say which ethical principle is being, breached. This is a clear breach of integrity. I can't write above professional competence because intentionally or knowing something that there are things are not in the right direction, he's assuming things will be in the right direction. So this is an integrity issue. And yeah, I can say professional competence issue as well. But second one, because of lack of knowledge, also he's saying all this, and also objectivity because he wants to cook the books. This is and a clear breach of professional competence, and also because he is motivated to show better financials. It is breach of. It is an objectivity issue as well. Okay, then what does it say? What does the mail say? Regarding the sustainability disclosure, he's asking to hide, conceal, plus he's asking to say we are meeting the practices. So, of course, let's talk about this. Regarding the report on sustainability disclosures, he is asking Shammi to clearly conceal things, conceal issues, or conceal issues, and not write much, even though clearly the organization had stopped complying to the sustainability guidelines, and even though clearly the organization had stopped complying to the sustainability guidelines and had not been able to meet the carbon emissions target. The standards on sustainability reporting will require to the report to be non-biased, free from error, reveal the risks to the society as a result of the organization's operations. If FD is deliberately asking to conceal the risks, then again an integrity issue. But if he is unaware of the IFRS S1 standard on sustainability, then it is a professional competence issue. Also asking the finance manager to show that they are complying to the best practice would also be greenwashing because they're showing something that they're not doing. Also asking the finance manager to showcase that Gillam is complying with the sustainability standards will also be greenwashing while it is actually not able to comply. Okay. Now, I think I've written enough of the issues. So because it's worth a 10 mark, so I can easily see if I'm getting 2 mark also for these per points. I've already written enough content for worth 6 to 7 marks. I need to just write actions. Yes, of course, you require the actions as well, right? They said that how should Shammi proceed? Okay, so now actions by Shammi. So you can even give a heading actions by Shammi. Shammi should take an understanding of the issue with the FD and accordingly advise the FD to take knowledge or to upskill on the knowledge for reporting standards. We'll write it as reporting standards. However, also Shammi should make the FD realize that these acts are professional breaches of ethical principles and has consequences of reputational damage to both himself, him, and organization. If the FD is still not able to understand the implications or act on upgrading the knowledge, then Shammi should take assistance from the internal audit committee and inform them of the current situation. As a last resort, if Shammi finds difficult to manage the issues and act professionally due to the influence of director, then he can consider resigning from the organization. It's simple. This is something we would also face in the real world, that we would try our best to, do the right accounting treatments, stick to the right accounting practices. Sometimes you will see the breaches happening. You can advise the people, the senior. And let's say if everyone around you is hand in glove and reporting is going to always happen in this fashion, then what do? You could try to inform the internal audit committee members. If that also does not work, then what can you do? You have an option to to not associate yourself with this organization, such organization, and then join another organization, right? No, it's not, Mahira Kant, about writing headings to get the 2 mark. No, it is not about that. When do you get the professional marks? When you have covered the requirement which was from the examiner. What was the requirement from the examiner? To clearly identify the ethical issues, to be able to give clearly actions after that. Let's say if you're giving a partial answer, you're not able to give the actions, you're just giving ethical issues. It's not a whole covered point, right? From a requirement perspective, he'll not be able to give you those professional marks. He'll not be able to give you. So the more better your 10 mark answer is developed, the more chances of that 2 mark you will get. Okay, you can't have a partial 50% written answer and then expect that 2 professional marks. That's not going to happen. The more you cover the requirement, clearly stating the issues and actions, the more better the chance of getting that 2 marks on uh, professional, the professional marks. Okay, so yeah. So this is my first question which were done for the day, and yeah, we went slow, but we wanted to be really clear with the accounting impact of it, so we have done that well. Now, what we'll do is we'll take a small break and then move to the next question for the day. We'll take a 10-minute break and then move to the question two of the day. Okay. The question two is Fuller Company. So yeah. Yes, that's right. So Batul, you can do like a 6:4 ratio, 7:3 ratio. It's not very fixated, Batul. They'll always play with a range. So you can imagine for identifying issues, it could be between 6 to 7. And for your actions, it could be anything between 3 to 4. It will be a range also. It will not be fixated. Okay. Uh, yeah, professional marks can go down, no? Because if your quality of answer is not good, then of course your professional marks can go down. Okay, so we'll take a 10-minute break. Everyone put a 10-minute timer. Ten minutes. All right, guys, please come back. The break is over. So as discussed prior to break, we're going to do the next question from section B, which is going to be an amalgamation question. So good practice on various standards. Come to this question called Fuller Company. We read the background requirement and one by one cater each and every scenario. This is the last question of the day. Bear with me. This is not going to be mostly as lengthy as what the previous question was. So it's okay. Y'all can like breathe. Okay, let's read the background and then we move to the requirement. Fuller Company operates an online food ordering platform. Very much in line with today's businesses, right? Many in every country, in wherever we are staying, I think today we all know that in our particular city, state, region, country, we do see some sort of online ordering platform. We do have applications in our mobile for online food ordering, mostly, right? Mostly. It prepares financial statements in accordance with IFRS accounting standards. The company has a financial year end of 31st December 20x7. Calendar year is the year end. The following exhibits available on the left-hand side of the screen provide information relevant to the question. The first one, food ordering platform, provides information about an agreement between Fuller and a restaurant, as well as information about vouchers that may be issued to the customers. So information on agreement between Fuller as a food ordering online platform and restaurant backend, and as well as information about the vouchers that they issue to customers front end. Okay. Now, technology provides information about investments in technology by Fuller Company. So it is going to provide information on some investments anyway. When we read the scenario, you will know. This information should be used to answer the question requirements within the response options provided. All right, let's read the requirement. Wow, a lot of requirements. Using Exhibit 1 and in accordance with IFRS 15 revenue from contracts with customer. Explain how Fuller should account for revenue from sale and delivery of Go Pizza food ordered on Fuller Food Company. Explain how Fuller should account for revenue. Should account for revenue. Very clearly the ask is account for revenue from the sale and delivery of Go Pizza. Account for revenue from sale and, sorry, the requirement itself, if we know clearly, we are in a position to, put the answers really very well. Yeah, and delivery of Go Pizza food ordered on the fullerfood.com platform in the year ended 31st December 2007. So clearly they want the accounting treatment for the revenue for two aspects, for sale and delivery. For sale and delivery, this is one thing. Then the second is explain accounting implications, if any, when the vouchers. So it's going to another scenario. So I don't want to get into that. I will focus on this first. Okay. So I've copied it. I want to take it on my word processor. Revenue on 31st December 20x7 from sale and delivery. This is key for me. From sale and delivery. This is very key for me. So is why I have put it like highlighted also. This is what I'm looking. This is what I'm looking for. Okay. Yes, but there is some numbers to it. There is some numbers to it. Because it's asking accounting, no? So then there is some numbers to it, okay? But yeah, a lot of writing only. So the focus is only this first Go Pizza scenario. We're not going to vouchers till we don't go to the next requirement, okay? Now, Fuller operates an online food or ordering platform, fullerfood.com. Go Pizza. On 1st August 2007, Fuller entered into a contract with a restaurant, Go Pizza, to add its menu to the fullerfood.com selling platform. Okay, so on 1st August 20x7, which is not right at the beginning of my year, right? Because my year ends at 31st December. So that's like how many months before my year ends? August, September, October, November, December. That's like 5 months before my year end. We entered into a contract with Go Pizza to add its menu on fullerfood.com. Okay. Yes, we will. Customers make an order using the fullerfood.com website and Fuller then passes the orders to Go Pizza. Understand what's happening. Customers will make an order on this website of Fuller Food, and Fuller Food will then pass this order to Go Pizza. So there is some service which Fuller Food is giving over here to customers and to this Go Pizza both. Okay. It's allowing the customers to make an order and it's allowing Go Pizza to take that order from us. Like it's allowing, so what we are doing is we are giving these orders, we're collecting these orders and we're giving these orders to Go Pizza, some service to them as well. Okay. Now, when the food is ready for delivery, it is collected by Fuller's delivery drivers and delivered to customers. So there is a delivery that we have taken care of. Okay, and there is so passes the order. Like this is one key thing that we're doing, taking orders and passing to Go Pizza. This is one thing, and then delivering to the customer. Okay. Now, the customers charge the price of the food ordered plus a delivery fee. This is what the customers charge. Charge the price of the food plus a delivery fee. The customer pays using Fuller's online payment system. Go Pizza sets the selling prices. Go Pizza sets the selling prices. Who sets the selling prices? Go Pizza sets the selling prices for the food options on its menu, and Fuller transfers 95% of the selling price of the food to Go Pizza when the delivery is complete. Okay. Now, some customers choose to collect the order from restaurant themselves rather than having it delivered. In this case, the customer pays no delivery fee. In the period from 1st August 2007 to 31st December 2007, the total amount charged to customers that ordered from Go Pizzas was 120,000, of which 21,000 related to delivery fees. So we have the numbers, we have the scenario as well. Now we need to know how do you account for it. Okay, when you read this scenario, and when you recall your IFRS 15 IPTPS, identify a contract, identify different performance obligations, identify the transaction price, allocate the transaction price to the different performance obligations, record the revenue when the performance obligation is satisfied, right? When you recall this IFRS 15, the 5-step revenue recognition model, and when you read this scenario, I want you to identify what are the different kind of obligations that Fuller Food performs. First, different obligations that Fuller Food performs. You know, out of IPTPS, one of the key thing is to identify different performance obligations. Identify the different performance. Is there only one performance obligation? Is there two? Is there three? What are the different performance obligations? Yeah, there are clearly very two performance obligations. One is delivering to the customer, and the other is taking order and passing to Go Pizza. Okay, so there are two things that it is doing. One is this literally when you take order means the sale part of the pizza. So there is a sale part of the pizza, and the other is delivery part of the pizza. Sale part of the pizza it's doing in together with Go Pizza. It can't do alone because that sale it has to make. It's providing a platform. But of course, that pizza is being made by Go Pizza. So the sale part is one and the delivery part is one. So two performance obligations. Okay. So for me, I have identified two performance obligations. Okay. So the Fuller company is two performing two performance obligations. One being sale of pizza and other being delivery of pizza. Now, the case where the sale of pizza is concerned, it's not doing alone. It is dependent highly on the Go Pizza company. Okay, now in this relationship of Fuller company and Go Pizza company, what kind of accounting you think Fuller company should do? Think and tell me what kind of accounting Fuller company should do. Absolutely correct. I think 4 to 5 people have started taking the right words or started using the right terminology. In IFRS 15, there is a concept of principal versus agent. For the pizza sale part, yes, Fuller company is acting like an agent. Why? Because it's not his it's not its primary responsibility on the satisfaction of the pizza quality, right? On the inventory part, it's not his primary responsibility. Is Go Fuller responsible, not Go Fuller, sorry, Fuller company responsible for the price setting part of the pizzas? No, it's not. Because that's also one of the key indicators of who the principal is. He's not responsible, it does not have the primary responsibility on the satisfaction of the pizza uh, quality. No responsibility on the price setting part, right? Then third, let's say if there is any issue with the inventory getting obsolete or something, it wouldn't have, we don't see that there is so inventory of pizzas is with whom? Is with Go Pizza only. So if they are getting obsolete or anything, Fuller company seems unaffected by it. So if you recall the principal versus agent, it meets all the criteria for an agent, not for an principal. The principal criteria is getting met by gopizza.com. So if it's just an agent from an accounting perspective, what should it record? From an accounting perspective, what should it record? Only the commission. Only the commission. So it should record only a commission on the pizza part. But where the say delivery of the pizza is concerned, where the delivery of the pizza is concerned, do you think in the case of delivery of the pizza, it is the main primary, it's the entity with primary responsibility, or here also it's acting like an agent for the delivery service? For the delivery service. For the delivery service, how does the Fuller company act like? It is main entity. It is main entity. There's no agent here. Rather, it is the principal entity, no agent here. It is the primary responsibility on the delivery part. Let's say the quality of the delivery. Again, it is Fuller which is responsibility. The price of delivery. I'm sure the price of delivery is not set by all the platforms that are there. It is set by Fuller company only, right? So any risk involved with that delivery is also with Fuller only. So for that particular piece, we would say it's clearly the primary responsibility of Fuller, and it's not that there is any agent here. It is primary responsibility, and full revenue should be recorded for delivery. No commission over there. Okay, we can explain in this fashion. So let's start then. In case of sale of pizza, it is performing this activity with gopizza.com, with GoPizza. Fuller company is allowing the customers to place the order on its website and then passes these orders to Fuller company. As a result, we can see that GoPizza has primary responsibility on the quality of the product, is setting up the prices for its products. Third, has the risk of inventory getting obsolete. Above characteristics are not shared by Fuller company. As a result, Fuller company only acts as an agent for sale of pizza and should record only commission to that extent. Therefore, a commission of dash should be recorded from 1st August 20x7 to 31st December 20x7. Now, I don't know what that commission is. We will just quickly check. We'll do the numerical and check. So from 120,000, first remove the 21,000. How much are we remaining with? We will be remaining with 99,000. So 99,000 and 5% of that. 5% of 99,000. Coming to 4,950. $4950. Till here, everyone is understood? Okay, great. Yeah. If inventory gets damaged due to delivery, then yes, it would become a risk. But obsolete, inventory getting obsolete that way, it's not his risk, no? Fine. Now, regarding the second obligation, which is delivery of pizza, it is the primary responsibility of Fuller Company to perform this. Also, it would set the price for delivery and have any response or would also set the price for delivery. Therefore, it should record complete revenue for the delivery in the period of 1st August 20x7 to 31st December 20x7, which is of $21,000 if I am not wrong. Yeah. As a result, in the profit and loss statement, we will see a revenue of recorded by 31st December 20x7. This is what they had clearly asked, and this is what we have provided. This is how much we will calculate. 25,950. Okay. To say that 4,950 is commission and 21,000 as revenue. See, the treatment of that commission, the tagging of that commission is also actually a core, I would say, for the way Fuller Company operates, commission is also a main source of income. Though his relationship in that transaction is of an agent, but commission itself is a main model of revenue as well, other than delivery, right? From all the entities on its platform, commission is one of the main source of its income, right? So it should be a revenue item. The tagging or the sitting of that GL should be in the revenue line item of my P&L. Okay. Yeah, and delivery also as a service will be one of the other portfolio of, earning revenue. Commission is one portfolio, delivery is one portfolio. They both will sit in my P&L in the revenue line item. Yeah. Now next thing, we'll go to the next requirement. So there might be multiple asks here, but individual asks I feel are like small. So they're very doable, I feel. Now, explain the accounting implications, if any, when the vouchers are issued to customer and the vouchers are used by customers. So they're asking accounting implications at 2 points. When issued and when the vouchers are used. Because if I do not want to see, writing the requirement itself is also safeguarding yourself on not missing the requirement. But again, writing subheading is also safeguarding yourself more. So vouchers issued, vouchers used. You can again give two subheadings to safeguard yourself more that you will not miss on the requirement. Okay, now let's read the exhibit. This is worth a 5 mark. So maybe not even this much writing. Okay. Now, Fuller wants to provide an incentive for customers to use fullerfood.com rather than other competing online food ordering platforms. As such, Fuller is considering giving each of its registered customers a voucher for free delivery on their next order. So all the customers that it has, they will see a pop-up. So you know, right? You have also food applications. I have Kita. I'm in Kuwait. I have Kita. So I will always see that. Okay, what vouchers do I have? I have a 2 KD discount voucher. I have a 3 KD discount voucher. Once I use the 3 KD discount voucher, it's gone. Then I have a 2 KD and 1 KD discount voucher still in my account. So that way they will issue, right, whenever they would want. So they have had a policy of delivery free delivery vouchers that they gave to all their customers. Now, if Fuller goes ahead with its plan, these vouchers would be emailed to customers in May 20x8 and they would be valid for 1 year. So, first of all, talking about this accounting year, they did not even go ahead with the plan. They're just planning. And the plan is to go ahead with this in May 20x8. And when they issue this, it would be valid for 1 year. Okay, when they issue this, it would be valid for 1 year. Fuller would bear the cost of the vouchers and would not pass the cost to restaurants that are listed on its platform. So this cost is going to be borne by the Fuller company. So there is something that it is doing for its customers. There is something that it is doing for its customers free of cost. It's not meaning free of cost to customers, but of course, Fuller will have to bear that cost. Fuller will have to bear that delivery fee. Fuller will have to bear that delivery expense. Okay. Fuller would bear the cost and would not pass the cost to restaurants that are listed on its platforms. Now, for me, clearly, till my accounting year end, 31st March 20, 31st December 20x7. If my accounting year is a 31st December 20x7, then in the year 31st December 20x7, they're like just brainstorming literally about this concept. Do you think anything you're going to do in the year ended 31st December 20x7 for this? In the year ended 31st December 20x7, do you think you're going to do anything for this? No, you're not. They're not going to do anything. Then when the year 31st December 20x7, 8 is coming, and if let's say they do go ahead with this plan and they do issue vouchers to the customer on May 20x8, just by issuing voucher to every customer, see, vouchers can get completely lapsed also. I have vouchers and they literally went lapsed. Okay, I did not use them. They completely went lapsed also. I have friends who are actively using vouchers. They will not let a single voucher go lapse. Okay. So the way the crowd behaves is very different, right? So just on instance of issuing a voucher, do you think that the organization should record something? It's default going to issue vouchers of free delivery to every customer. On the instance of issuing, do you think it should record something? Yeah. See, guys, the issue of the voucher to the customer will actually not create any binding of the organization. If you think, it will not create any binding to the organization. Because for you to be able to record this, there has to be like a contract kind of thing between you and the customer. And just issuing voucher will not really lead to a binding contract between you and the customer. When the customer demands and uses the voucher, then yes, it becomes binding on you to give the free delivery. At that point of time, yes, you will have to account for it. Okay. At that point of time, you have to account. If anyone adds this flavor of past practice, that in the past we have seen like 99% or more than, the customers, if the customers have always ended up completely using these vouchers, then yes, a provision in that case, yes. But because they're not giving me any light on past practice, they're not telling me that, okay, customers are using this, then as a basis of past practice, then for me to account for it would not be the right thing. I will only account for it when I actually, when the customers actually end up using it. Okay. Till I don't see any past practice kind of highlights here. And what about the cost that the entity is bearing? Can you all think how the entity would record for the cost? See, if it's going to give free delivery, then that free delivery it is giving to whom? To its customers. Can you all recall one subtopic in IFRS 15 which is connected to this? Can you tell me that for the part where I'm giving free delivery, that particular part, how do I record? Yeah, consideration given to customers, right? Do you all remember a topic called consideration paid to customers? And where you had to identify, are you giving this for a distinct service or not giving for distinct service? If this voucher free delivery, this free delivery I'm giving, and if this is like a consideration to customer, will this be for a distinct service? Will this be for a distinct service that I am taking from the customer or distinct good that I'm taking for, or will it be not for a distinct good or service? Will it come in the category of distinct good or service that I'm taking from customer or not category? Tevalmar is saying it's coming as a distinct service. Am I taking some service from customer? Am I making this kind of payment kind of thing for something for which I'm taking some? No, I'm not, right? So if that is the case, if you are going to make a payment to customer for not a distinct good or service, then what is the accounting treatment? What is the accounting treatment? If you're making a payment to your own customer, not for any good or service, not for any good or service, then how do you treat it? Absolutely correct. You deduct it from revenue. Distinct good or service, Ram, means that if you're making a payment to customer, and this is not a direct payment, but like considered like a payment to a customer, then if you're going to make a payment to customer, you have to see why you're making payment to a customer. Is it some service that you're taking from a customer and you're paying for that? Is it a good that you're taking? Then record it normally. If it's an inventory item that you've procured from a customer, which is possible, then record it like a debit purchase, debit inventory. If it's a service that you're taking, some rental utility, rental services, then record it as a debit rental expense. But if it's not, this payment you're not making to a customer for any service or any goods, then it has to be reduced from your revenue. Then it's like a reduced revenue. Okay. The treatment is it will sit in my revenue line item. This is what IFRS 15 consideration paid to a customer topic will tell you. This is a very specific topic. And most of you all were able to recall it. Okay. So yeah, provision, guys, all those who are suggesting provision, yes, you could write in that case, then you'll have to write a heavy assumption sentence that this is basis that in the past, majority of the customers have ended up taking free delivery service. And as per past practice, there is a likelihood, but for me, when that information is missing that I see, I don't see these percentages, 35% or 40% customers will take up or do take up, then for me, I'm not going to, write this. But if anyone ends up writing this also, I wouldn't say it's wrong. I wouldn't say it's wrong. So I see like there was literally a possibility of two kind of suggestions for accounting treatment. One is nothing happens at an issue. And second is, yes, you record a provision at the issue time basis the past practice and when you know the past practice. Okay, when you know the past practice. If you don't know, then there is nothing that you can record because it has to be measurable, no? It has to be measurable. Okay, vouchers issued. Firstly, in the year ended 31st December 20x7, we will not record any, we will not pass any, we will not pass any accounting impact for vouchers as this is a plan not yet implemented and just under discussion. Secondly, if this plan is implemented and vouchers are issued in the year 20x8, then at the time of issue, as there is no binding on the organization to perform the delivery till the voucher is not utilized, The entity is what? Fuller, right? Fuller company need not record any expense or provision for this. When the vouchers are used. The binding on the organization appears when the vouchers were utilized by the customers. When the vouchers are utilized by the customers, this will act like a consideration payable to customers. However, this will fall under the non-distinct, under the category of payment made not for any distinct good or service. In such case, the delivery expense has to be deducted from the revenue, and the revenue reported in the financials has to be a net figure as per IFRS 15. Some people did suggest provision, so I'll talk about it if I have the past patterns. If we have, so on the issue part, okay, however, if there were past patterns available on the delivery vouchers, on the application of delivery vouchers, then a provision could have been taken basis it. Okay, so I have done the provision also on the safe side. But because I'm assuming there's no past pattern, I'm suggesting this treatment. It is also still okay to not mention provision. It's also okay to mention provision. It's fine. Okay, so I hope everyone has understood till here. So we have covered the 8-mark requirement. We have covered the 5-mark requirement. Now let's read the final requirement. Using Exhibit 2 and in accordance with IS 38 intangible assets, explain how technology and data held by Fuller should be accounted for in its financial statements, and discuss whether the accounting treatment of Fuller's technology and data provides its investors with useful information. Okay. Now let's read. During the year ended 31st December 20x7, Fuller has invested in technology which collects data about food orders and deliveries from Fuller's computerized operating systems, and using algorithms transfers it into artificial intelligence AI-powered information. So it has invested in technology. One, this is for me what I have purchased. I have purchased a technology. Clearly, I have made a purchase which collects data about food orders and delivers from Fuller's computerized accounting systems using algorithms and transferred it into artificial intelligence powered information. So there is a discussion on data collected and converting that data Why is it not getting highlighted? I don't know. Okay, it's getting highlighted green, but I want a different color. Okay, yellow. So it has invested in technology. What it will do, it will collect data and it will give output as the AI powered information. This is my output. Input is data and output is the AI powered information, and I have invested in technology. As additional data is collected and transformed, the AI continually improves its knowledge of factors such as traffic conditions at certain times of the day. And so the value of the AI powered information grows exponentially. The value of AI powered information grows exponentially. Fuller uses the AI powered information to provide an increasingly efficient service when connecting delivery drivers, restaurants, and customers, so resulting in higher revenues and reduced costs. Okay, so when it's using the AI powered information, of course, it's able to leverage on when to send the drivers, which restaurants to, flash for the customers, leading to higher revenues and reduced costs. Fuller has put in place robust security measures to protect the raw data, algorithms, and AI powered information. So, robust security measures are also there in place. Okay. Just 1 second. Someone's at my door, guys. Yeah, I'm sorry, guys. We'll continue. So, yeah. So let's think again. Let's put things into place. Fuller Company has purchased a technology. What does that technology does? It takes the data on the food orders, customers, deliveries, everything, converts it into AI powered information. So it takes data, converts into AI powered information. What Fuller Company will do? It will use that AI powered information to leverage on when to schedule the delivery. I mean, at what time the maximum drivers should be there, what restaurants to flash to the customers, all this, right? So this results in additional revenue and reduces the cost. Can you see this? When it's using the AI powered information, it is resulting in higher revenues and reduced cost. And Fuller has robust security measures to protect this data, algorithms, and AI powered information. So it has control also in that fashion. It has control also in that fashion. Now, Fuller paid a third party 820,000 for its data management software. For the data management software that it has purchased, it's paid 820,000 and a further 1.2 million for AI technology, including the algorithms. For the AI technology and for the data management software, it has purchased some amount. It employs skilled individuals to refine and streamline these algorithms on an ongoing basis and paid these employees 630,000 in the year ended 31st December 2087. The value to Fuller of the improvements to the algorithms significantly exceeds the amount paid to the staff to refine them. So there's good information on many pieces over here, okay? One is how we are dealing with the data. What is the data doing for us? We have purchased the technology, and what technology have purchased and for what price? Purchase of technology is mentioned in the first line, but what we have purchased over here in the last paragraph. Also, improvement on the technology. We have employed skilled labors and it is improving, and that is also giving economic resources to our organization. And that information is also there. Now, for me, I have question for you all. Let's first again, in such questions, you need to revisit the questions, by the way, again and again. Explain how the technology and data held by Fuller should be accounted for. Let's see precisely what they're asking. The requirement is on. It's B, right? Yeah, it's B. Technology and the data part. The technology that it is purchasing, which is data management software and the AI technology for including the algorithms, this too. Do you think that we can recognize this as an intangible assets, IA? Can the purchased elements, can you recognize this as an intangible assets? Do you think it can be recognized as an intangible assets? Yes or no? Yes, very much yes. Why? Does it meet the definition or the criteria of intangible asset? What is the definition of the criteria of intangible asset? It is an identifiable non-monetary asset without a physical substance. Okay, this is one. Identifiable non-monetary item asset without a physical substance. This is the definition. But what about the recognition criteria? The recognition criteria will be the entity should have control over it. It should be separable. It should give economic benefits to the entity. The other three criteria for recognition, which is there for any asset, So you should see that the definition and recognition is being met for this too or not. If yes, then yes, we have to recognize this. Is it a non-monetary, identifiable non-monetary? Yes, it's identifiable. I am purchasing a management software. It's identifiable 820. Is it separable? How do you know it's identifiable? It's identifiable because it will be separable. If you're purchasing something, most likely it's something sellable also. Let's say even if it's not sellable, but it's coming out of some contractual rights, then that's also one more criteria for separable. So if it's separable, it's identifiable. Okay. So it's identifiable, non-monetary. Yes, it's non-monetary because default, this DMS, the data management software, and the AI technology is not something that gives you the right to receive cash. It's not like shares, right? So it's non-monetary and it's not without it's without a physical substance. So the three criteria for the definition of intangible asset, check, met. What about the recognition criteria, economic benefits, control, all of that, is it being met? We can see so many times they're talking about the economic benefits, reduce cost, increase revenue. They are talking about it on and on. So yes, economic benefits are there. Is there a control? Yes, because we have robust security measures. So there is control as well. So if meeting the recognition criteria as well. Okay, identifiable, separable, recognition criteria, all that is being met as well. Controlled by the entity, benefits flowing to the entity being met. So yes, for this part, yes. When you recognize an intangible asset, you might end up spending further on it. But when you spend further on it, that will become an internally generated intangible asset if you are going to capitalize. And for internally generated intangible asset, again, there is another criteria that needs to be met to capitalize it. It is improving its algorithms. For that, it is spending on employees 630,000. Do you think the 630,000 can be capitalized? Is it measurable? Is it adding value? Is it measurable? Is it increasing, enhancing it? Yes, it is. So for me also, the 630,000 is something that can be further capitalized. Okay, further capitalized. This 630,000 also for me says something that it can be further capitalized because it's again leading to improvements which exceeds the benefits paid to the cost. So clearly all this for me meets IS 38. All this meets IS 38. See, Mahira Khan, not everything can be looked into the lens of employee cost not helping to bring the asset to present condition. There could be those kind of costs, but in the subsequent phase also you are allowed to capitalize some elements, right? That has to independently meet its own criteria, right? Independently meets its own criteria. Yeah, it's like an that particular element will be like an internally generated intangible assets, which is meeting a criteria is why we are capitalizing it. It's not employee skills that we are capitalizing. Hamad, we are not capitalizing employee skills. Look at it. What is happening? It's employee skills, skilled individuals to refine and streamline these algorithms. They are refining and streamlining. So my algorithms, what happened? How come everything got highlighted? They are refining these algorithms. What I have in control are the algorithms with me. I don't have the employees in control, agreed. But they are refining and streamlining. See, if there is a software developer who's coming and making a software for you, who has the rights on the software? The entity has rights on the software. The entity has rights on the software, right? The entity maybe does not have control on that employee. That employee can go and leave. So when the employee is getting skilled or trained, those training costs I can't capitalize. But anything that the employee is doing for me for that particular coding, the let's say the regular salary that I'm paying, that I can capitalize, but not his training cost, because training cost is something with him. Training cost is something with him. Yeah, okay. Even if it's staff, right? There is a part of staff that you can capitalize, no? You can capitalize the employee benefits that you're paying. You can capitalize those costs also, right? Till the time it is meeting the criteria. Exclusive. training cost is deliberately highlighted as something not. So these are not training costs, no? These are not training costs. Okay. So anyway, for this paragraph, feel like the purchase of data management, the purchase of the technology for AI, the improvement of the AI, all these are capitalization. Okay, for me, all these are capitalization for me. But then there is another thing in question, talking about data, the customer database, the food that they order, their phone number, their contact number, the data, okay? When the maximum delivery, when that's converted into artificial intelligence information, that artificial intelligence data also. Do you think that the data part, can we capitalize as an intangible asset? This part, can we capitalize? No. Why no? Why do you say no? Why do you guys say no for the data part? Because that is internally generated, agreed, that's one thing, plus data internally generated like customer list will also not meet the condition. No, that's almost like that debarred item from capitalizing. It's internally generated, and plus I can't give any measure for something. See, for this employee cost, it was measurable, I knew how much I was spending. For this data that is getting enhanced and getting richer and richer, though it's reducing my revenue, though it's reducing my cost and increasing my revenue, it's not measurable. The data itself is not measurable. So I cannot. Yeah. Okay. So very clear cut, I have guidelines. So I'm going to develop the answer here. Okay. I could go ahead and I can do the IS 38. What does the intangible 38 intangible assets states, and then apply to the scenario, or I can do it while I'm applying parallel. Okay. So this application style, or there is a state and application style. It's up to you. I'll go with a natural flow. For me, when I'm talking about this technology, and I'm going to prove that it's identifiable, it's separable. I'm going to do the parallel approach rather than doing a state and apply. Okay. I'm going to do a parallel approach. So, Polar Company, what is happening? Polar Company has purchased data management software and AI technology. It has also generated, it also has rich data and has converted this data into intelligent AI or AI powered data as well. Regarding the purchase of DMS for, sorry, I've chosen the wrong exhibit. 820, and then you have AI technology for 1.1. Regarding the purchase of data management software DMS for 820,000, and the technology for 1.2 million, we can see that both of these are purchased intangible assets. Second, are identifiable as they are separable, because there would be contractual rights attached to it. And because they are purchased, they could be sold as well, but I'm not sure. So I'm writing they could be sold as well. Third, they are non-monetary in nature, unlike shares. Fourth, they do not have a physical substance and act like licenses, patents, etc. Like the nature I'm trying to explain, that they're non-physical. Fourth, fifth, they provide economic benefits to the entity as they have resulted in increased revenue and reduced costs. They have entity also has control over it, as entity has put very tough security measures on it so that others cannot access and take advantage of it. As such, both these purchased items meet the criteria for recognition of intangible assets and should be capitalized on the balance sheet on their purchase. Depending on the contract life, amortization should also be charged on it. Secondly, employee has also been hired for the improvement of algorithms. We can see that this has again resulted in increased revenue, and as such, this is also meeting the criteria of subsequent capitalization, as the amount is also measurable. Therefore, this 630,000, if I'm not wrong, it's 630,000. Yeah. This $630,000 should also get capitalized along with the carrying value of the assets in the balance sheet. Okay. So yeah, this is perfect. Now let's talk about the data part also. Yeah, we can, and rather we should, because that's a more, a direct statement or direct proof for why we should capitalize. Also, this meets the criteria of asset being enhanced is why it is also relevant to capitalize this amount. This is something we had discussed also, but we did not put it up in written, but thanks for reminding. Okay, now the data part. Regarding the internally generated data from the customers and the deliveries, even though they lead to increased revenue and reduced cost, they should not be capitalized. Okay, wait, guys. Apologies, my daughter had come. So anyway. So regarding the internally generated data from the customers and the deliveries, even though they lead to increased revenue and reduced cost, they should not be capitalized. Why? This is because IS 38 strictly prohibits the capitalization of such, not every, but of such internally generated intangible asset, as they will fall in line with customer list, because customer list is something it will explicitly mention do not capitalize. Also, similarly, the AI powered data should not be capitalized. The date, both categories of data are also not measurable, and therefore again do not meet the recognition criteria. So guys, might have shifted a little bit from the state apply approach, but you could do a state apply. Like you could literally say IS 38 says, what is the criteria that it should be identifiable, non-monetary, physical, blah, 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 and then do the application. But it can always also be a state apply parallel approach, which means that when I'm putting up these points, I'm also doing the application and I'm also stating. If you see, this is literally what the standard says. But at the same time, I'm doing an application also while saying that, yeah, this is all being met in this scenario as well. This is the approach that I took. Okay. It's really up to you. Always, when I give the state apply framework, it is because you all find it difficult to develop answers. Why I give a approach, a clear cut approach. You can do the stating of principle and you can do the application, and that's how you can fetch marks. But if anyone wants to directly do application, and in that application itself stating is included, it's a parallel approach and stating is included, it's completely okay. It's rather a better approach. It's rather a better approach. Okay. Only those students who find difficult to develop answers and make points should use a separate state, separate apply, I would say. Right. Directly jumping to application will also fetch marks. So you can go to that as well. Okay. I hope this is clear. Now, when you say second part, you mean this, right? Discuss whether the accounting treatment is useful for the investor focus part, right? This is what you mean, Maherakant? So yeah, we're going to move to that now. Yes, that's a final leg. Now we're going to move to that. Okay. Using Exhibit 2 and in accordance with IS 38 Intangible, this next part. Discuss whether the accounting treatment of Fuller's technology and data provides its investors with useful information. So this is also, yes, using some theory element from your conceptual framework piece, And it's also a lot to do with general knowledge. Okay, it's also a lot to do with general knowledge. So you have to write about, like, I would say, decent 4 points here to get the 4 mark here. I can easily say that 6 marks easily could have been dedicated for the first part. So next part could be a 4 to 5 mark. Let's say if you played in the strategy of 5 to 6 marks here, again a 5 to 6 marks here as well. So, or sorry, uh if you have done a 5 to 6 mark writing. So if you've done a 6 mark writing, then you need 4 mark here. If you've done a 5 mark writing, then you need a 5 mark here. So I have written pretty much a lot over here, and this is good enough for getting a 6 mark. So I know that for my investor focus, I need to write at least enough so that I get 4 marks at least, right? So yes, you can play with the strategy. Now, I need to show that how this information of accounting treatment of technology and data could be useful to the investors. Okay, so let's develop answer for this. Let me pull this on my word space. What could be a useful information for investors? Okay, how could information be useful to investors? Can you all think about it? Do you all remember some terms from your conceptual framework that what can be useful information for the investors? What should be considered as useful information to the investors? Something that can help them do the decision making, something that is relevant for them, something that is complete as an information, something that is free from error as an information, right? These are the characteristics of information which will make useful for investors. So you have to see all this information on data and technology in light of the characteristics of useful information. What can be useful information? Again, something that will help in decision making to the investors, something that can be relevant, something that is comparable as an information, something that is complete as an information, something that is free from error as an information, right? All these would be characteristics of useful information for investors. So we have to see this technology and data in the light of this. Okay, the lens is these five things that we have for useful information. Okay, now, in order for the information to be useful for the investors, it should be helpful for the investors in decision making as to whether it should invest in the company or not. The information on data and technology could enable the decision making as technology, as the treatment of technology has direct impact on the financial statements, and so it will improve the net worth of the organization and will have improved revenues and reduced costs. All this can result in investor being influenced with the decision making. This is one thing. Now, what else can I write? And makes the information relevant for the investors. Okay. The next. In order for the information to be useful, it also needs to be complete. While we do show the technology on the face of financials. We do not show data on the face of financials. Even though it has huge economic benefits to the entity. This can easily confuse the investors due to difference in accounting treatment for both. Meaning, in one of the characteristics of useful information is that when you're printing something on the financials, you can't show, see, you can't, not you can't, rather there is some piece of information that you're showcasing and then there is something that you're not showcasing. In case of, this particular technology and data relationship, you are showcasing technology on the face of financials, but you're not showing data. So it's not like a complete set of information. The users of the financial statements are not able to judge about the impact of data, the benefit of data. So it's like an incomplete information for them. It's not complete, it's like incomplete. But you can't change the account, you can't change the treatment because accounting treatment is still not letting you. But what impact it has on the usefulness, yes, it is incomplete and it will confuse the users of the financial statements. Okay. Yes, complete, neutral, and free from error. This is also a characteristic for useful information. Absolutely correct. Okay. This has to be in the first, in the beginning of the study hub where you have conceptual framework related notes. This is there. No, Mahira Khan, we will never say that you should disclose customer data. That's not what the expectation will be. The expectation will be that how do you value data? Because if data is bringing so much worth to the organization, so much increased revenue, reduction in cost, how do you present the benefit of that data? Then there has to be some, like how you have a standard that has got newly developed on sustainability reporting. Some standard could get developed on data. Why? Because of the shift in the way the entities are, working now. A lot of entities are data dependent, data driven. Their uh, revenue and cost of sales reduction is very much data driven. So maybe there is today a need of new standard, and maybe if not monetary cost in the financials, but some disclosures on data. Disclosures like what? Disclosures like how rich the customer database is, what kind of reduction it is leading to in the cost, what kind of increased impact it is leading to in revenue. Maybe not the disclosing of the data as to what is the customer name, the phone number, not that, but the kind of benefits, the kind of reduction in expenses, all this. Okay, maybe that. Therefore, in order to show complete information, it would be required with time to have dedicated standard on treatment of data and its disclosure on the financial statements. Also, as so many organizations are data dependent and data driven, disclosing data related benefits will also make this piece of information comparable with other entities disclosed information on data, especially if there is a standard around this. It also requires that this that the information, on the face of financial and disclosed in the notes is also neutral and free from error. The strict guidelines in IS 38 on recording the aspects which are measurable enables the information to be neutral and free from error. Okay. So yes, I had to write something worth 4 mark to show that how useful information, what useful information characteristics are, and the accounting treatment of Fuller's technology and data, how it is, in line with that useful information characteristics or not. So somewhere, yes, it's in line. Somewhere it's not. So we have even guided as to what could be there. There could be a standard, there could be disclosure around that. So this is how you would talk about investor focus, little bit from your conceptual framework, little bit, or I would say a lot of general knowledge. A lot of general knowledge writing is also over here required. Okay. So yes, with this we come to an end to the requirement of this particular question. Answering the requirement by fulfilling the expectation of the examiner will, yes, give you the professional marks. Answering the requirement by fulfilling the expectation, incomplete answer, not catering or hitting the nail, because sometimes what will happen, because you will state the standard, so somehow the examiner will be able to give you a half mark here and there for stating the standard. But if it's not directly covering your requirement, it will not be able to give you the professional marks there. So it will be in a margin to give you a mark for the state part, because state is an easy mark. For stating principles it's easy, but because you did not apply to the scenario, you can't get that professional marks. So I'm going to target the question 4, meaning question 3 actually. Edison, we have a 7th session of SBR, right? We have a 7th session during the weekday in this week for SBR. So I'm targeting that question there. Edison or another question, but mostly I'm going to target Edison only in that 7th session of our SBR. Okay? Yes, I will be sharing these answers also. I'll have to now take snapshot because I have put these answers, in the word processing spreadsheet. So, and I think you can't do a control C, control V, anything from here to word. So let me take snapshots and then let me take it to let me preserve this as a PDF and share it with you guys. Yeah, there is a 7th session during the week. It's in this coming week. A 7th session plus a 50-mark mock plus the debrief of a 50-mark mock. A lot of practice planned in this week, guys. Yes, Batul, tell me, dear.
Ma'am, in the mock exam, the group question is on consolidated profit and loss statement. So does that mean that in the exam, the group question will also be on consolidated P&L?
No. It does not mean it does not mean. In fact, I'll tell you how it behaves. The pre-mocks when they get released, right? Of course, it's a good practice. Okay, whatever we are doing right now is a good practice. But the way I have seen it works is the paper that will get released, the real paper, will have elements from older pre-mocks. Will have elements from older pre-mocks. So not from the recent pre-mock release, March 2026, but the one that they have taken out from the website. It will have elements from that. So high chance older pre-mock getting tested in the real exam rather than the latest one. This is how ACCA exams behave. But what they do is the older pre-mocks they remove from their websites.
And where can we get those mocks?
The good part is I try to preserve as much as I can, and the older pre-mock I will give you as a 100-mark mock that you will crack, I'll give you as that. The 50-mark mock that you crack, I will give you as that. So one old pre-mock I'll be able to release in that fashion. Another 50-mark pre-mock I'll be able to release as a 50-mark. So I will be able to release that much. If I have anything extra beyond that still preserved, I will try to share that question paper. But yeah, 2 papers at least I'm sharing. in a 50-mark pre-mock and a 100-mark in the 50-mark mock and a 100-mark mock of VIFHE. In there I'm sharing.
Okay, ma'am. Thank you.
Welcome. Yes, 7th session is available for all batches, for the regular batch, for the reset batch, for the revision batch, or the crash batch. For all batches, the 7th session is available. Okay. Fine then, guys. See you in the coming week. We are going to meet, I think, 3 times almost. One time in the 7th session, the 50-mark mock that you crack, invigilator is going to be there mostly. But in the debrief, again, I'm there. So yes, see you all in the coming week. And then again on the weekend for the grand revision. Yeah, it's okay. One bubble question. If you skip, it's completely okay. But let me see. Let me make a note. Bubble, bubble, bubble. Bubble is a, how have I highlighted? Is it a study hub question or is it a past paper question? Bubble, as far as I remember, is I think a past paper question. But yeah, it's okay. I mean, we have done enough, a lot of practice. So it's okay if you're skipping one question in that sense. But if you want, let me see with the IT team if we can, um, you know, um, get a bubble recording of previous class. Yeah, okay, understood. That it is the one which is a old Kaplan kid question and the kid doesn't have it. Okay, forget, then ignore it. It's on Study Hub. Okay, let me check. Then if it's on Study Hub, if time permits, but now I'm just thinking which session to include this in. In this case, I could include it in the 50-mark mock and then I explain it as a debrief for you all. See, I have two things. I can take Edison in my 7th session or I can take Bubble. I want recommendation from you all. Should I take Bubble or should I take Edison? Okay. I think it's a section B type that you all want to see, right? Amalgamation. So yes, I'll be taking Edison then. Bubble, Mahira Khan, the deal with Bubble, I'll tell you what. So many consolidations we have practiced. No, we have too much. We have like a, I would say, what, treasure of consolidation practice questions. We have many, no? So if you still need Bubble, then I'll have to include this in my in my 50-mark mock, and then not give you the pre-mark mock, not give the pre-mock original question in that 50-mark. Yeah. Okay, let me assess. Let me assess the level of bubble. If it has repetitive elements and I don't see any freshness in it, I will not. But if, let's say, if it is really adding value, then let me see whether to include it in a 50-mark mock or a 100-mark mock or not to include, because you all would want visibility on the pre-mocks, Let me see. Okay, I'll figure it out. All right. Thank you, everyone. Thank you so much for being in the session for this long, being this patient. Coming week, focus on practice, all social commitments aside for 2 weeks now. Crucial 2 weeks. All social commitments aside, please. Thank you so much. Thank you. Yep. Bye-bye. Bye-bye.